Welcome to the Masterclass information session. Today we're going to be talking about three courses that comprise the 2026 offerings at the JPMCC. We have Foundations of Commodity Markets, which is going to be taking place in April, the Masterclass in Commodity Trading and Hedging, which is going to be taking place in May, and the Masterclass Commodity Options, which is going to be held in June. Foundations of Commodity Markets. The Foundations of Commodity Markets course is really intended to be a practical deep dive into the underlying mechanics of physical and financial commodity markets, as well as the techniques that are used by trading and hedging firms to collect fundamental information and process it into an informed perspective on the future of price. To do that, we're going to look at 8 lessons. First, we're going to look at the commodity market participants. The entities that are present in the commodity market are there for much different reasons than one might typically see in a more traditional financial market. There are entities that have organic risks that are looking to shed, people are looking to take risks for speculative profit, and entities that facilitate transactions. It's important to understand what every single person is doing in the commodity markets because their transactional needs and their organic business will, to a large extent, determine sort of the types of transactions they'll be doing and the sort of business they'll be interested in, the type of trade they'll do. For the second class, we'll look at physical and financial commodity markets. The commodity markets are very different than more traditional financial markets because there are essentially 2 of them. There's a financial market where people trade futures, swaps, and other derivatives, but there's also an underlying physical market, and this is where the complexity comes from. The physical market for commodities is driven by supply, demand, constraint, production, and processing. And that complexity makes it very, very difficult to sort of understand how price changes and how changes in supply and demand translate into price, which then proceed to affect the financial market. So in the commodity space, you really must understand both of those things. To do that, we'll look at 2 fundamental analytical techniques. First, we'll explore traditional fundamental analysis. This is where we look at supply, we look at demand, we look at the intersection. We build what's called a balance sheet to understand how the current market is disposed and how that supply-demand balance might inform price in the future. We'll look at demand curves and supply curves, and we'll look at analytical techniques that have been employed in the industry for literally 100 years. The fourth class, though, is much more novel. This is where we'll explore quantitative and non-traditional data analysis. The advent of new technologies in terms of coding, in terms of massively available data, in terms of non-traditional data sources, things like web scraping and social media analysis and satellite imagery, has really allowed commodity traders to bring different and interesting tools to the table. So we'll look at how those are currently utilized. We'll look at volatility. The commodity markets sort of are inherently structurally more volatile than many other types of products, and that volatility is linked back to the physical nature and of the markets. There are simply more things that can impact the price of a commodity than there are for just about any other instrument. So you have to understand how that volatility exists, and more importantly for commodities traders, how that volatility is changeable under different fundamental scenarios. That volatility will translate into risk, the risk that the trader takes with the positions that they assume, how that risk is measured with respect to their firm, and how they must manage that risk as a trader. The 7th class covers developing a cohesive view of the market. And this is really the core job of anyone who's involved in the market. What do you think is going to happen? How do you translate that fundamental analysis via traditional and non-traditional methods? Do you incorporate your perception of the volatility and how that translates into risk and turn that into a perspective on what you think is going to happen in the future? This is the most important class, and it's the most important skill in the commodity markets. The course concludes with an overview of trading and portfolio management, where essentially we look at everything else that happens downstream from the trader or the analyst view. You know what you think is going to happen. Then we talk about what you do with that, how one evaluates candidate trading strategies, puts on a position, and manages it. The Masterclass in Commodity Trading and Hedging. The Masterclass in Commodity Trading and Hedging explores how traders evaluate directional, spread, and option positions, select the optimal strategy to express their view of the market, and transact efficiently in the market to minimize impacts and costs, and then manage the risk of the resulting exposures. We begin with developing a cohesive view of the market. Again, this is the core skill, And as this class is very much focused on trading, we look at how a trader would form their perspective on what they think is going to happen, including assessing the risk and reward inherent in the market and figuring out probabilistically what they think is going to happen. Then you'll examine three different types of trading strategies, the three primary ones that most traders in the commodity markets might have access to. Directional trading strategies, betting on purely up or down, which sounds simple, but in fact is quite complex. Spread trading strategies, where the trader will buy one instrument and sell another instrument to bet on either a reversion from a current level or the explosion away from that stasis level to different price levels. Spread trading is very much one of the primary strategies that's used in the commodity markets because it's one of the most flexible things you can do, and it allows you to make your position yourself with respect to time, buying and selling different months, product, buying inputs or outputs, buying different qualities, buying things that are geographically dispersed. Again, one of the absolute core skills in all of commodity trading. Thirdly, we'll look at option trading, the most complex type of trading that is done in the commodity markets. Options are incredibly interesting instruments that have only been around for about 30 or 40 years, but they allow the trader to bet on nonlinear price moves and make bets that are essentially loss limited, which is, again, incredibly interesting in markets that are very volatile. Once the trader has examined directional, spread, and option trading strategies, they have to decide what they're going to do. So then we'll examine selecting the optimal implementation strategy. Every trader has constraints, every trader has goals, every trader has things that they're trying to do with their perspective on the market. At various points in time, given what's available to you, given the liquidity that's available, given the players that are present in the market, there may be certain things that will be presented to you as things you could do: a directional trade, several spread trades, an option trade. How do you evaluate those? How do you look at what you could do and determine what the best thing is to do? Once you've done that, trading and execution skills discusses how one actually puts the position on. In the modern financial markets, there are many ways one could transact: calling a counterparty directly, using a broker, using an online execution platform. What's the best thing to do given the current market that you're facing and what you're trying to achieve? Once you have put on the position, then you have to manage it. You have to figure out how to handle that position, how to optimize its performance, and also potentially work with that as part of a larger book of other positions. And lastly, we'll look at something that's very core to the commodity markets: pricing and hedging and optimizing structured transactions. For many participants, particularly those that work at merchants and banks, a lot of your day-to-day activity will be pricing deals or pricing transactions for customers. So you have to understand how to take a look at a document or a request from a customer and say, what is this thing that they're asking me for? How can I break that down into pieces? How can I understand the inherent risks and how can I price them? And how can I find a way to execute this transaction in a way that makes sense for both me and the customer? So that's how we'll conclude commodity trading and hedging. The Masterclass Commodity Options. Commodity options provides a solid grounding in both theory that serves as a foundation for a detailed practical exploration of the intricacies of pricing, trading, and hedging physical option products and complex structured transactions. Options are the most complicated instruments that most people will experience as trading in the commodity markets. The 8 classes that comprise commodity options find a way to work through both the theory and the practice. We start with an overview of the physical and financial commodity markets. We have to understand what makes the commodity markets different from typical financial products like stocks, bonds, foreign exchange, because in those nuanced differences are the reasons why we have to treat and pricing commodity options somewhat differently than one would do with a typical, stock option. We'll look at the foundational principles of option pricing, how option pricing actually works, what an option is, how it functions, the mechanics of an option as an instrument. We'll look at single option payouts and multi-option structures. Options offer tremendous flexibility. You can have buy or sell one single option and use that as a position, or you can combine 2, 3, 4, 5, 8, as many as you'd like options into what's called a structure that has very unique, very specified performance characteristics. Once one has that, one has to know, of course, how to value it, how to price it. And there are 2 primary ways that we'll do that in the commodity markets. The first model that anyone ever used was the Black-Scholes pricing model. It is the original option pricing model, originally built for equities. We use a slightly different version of it for commodities, but the underlying logic is still very much the same. There's also what's called the binomial tree pricing model. That is used for pricing options where there are slightly different characteristics. So it's important to understand the theoretical underpinnings of both the Black-Scholes and the binomial tree pricing models. The models can give you a price, but the models can also generate what are called Greek risks. And this is a type of risk that is wholly unique to the option markets. Essentially, Greek risks, and there are many, are performance characteristics or performance metrics that describe how an option will move through time as various underlying variables move. An option is not just moved by the price of the underlying, or the price of the security. It's moved by volatility. It's moved by time. It's moved by interest rates and a number of other factors. So the Greek risks describe those. Look at how those work and how options can be combined into portfolios and traded as a package. We'll then take that grounding in theory and start to apply it to commodity options. We'll look at physical and financial commodity options and how the nuances and differentiation of physical options with all of the inherent characteristics, lower liquidity, higher volatility, how one translates that theoretical base into practical action in the commodity markets. And lastly, we'll look at real and embedded options in structured transactions. The types of deals that if you work at a bank, if you work at a merchant, you will be shown by customers all day long, sometimes include optionality. Sometimes it's explicitly stated. Sometimes it's merely described in the language of the contract. Either way, you have to understand how to disentangle that, how to recognize, disentangle, and then model and price that option to be able to price the transaction appropriately. So with that, we can move on to some Q&A. I'm going to put this back to multi-screen so everyone can see themselves. Or if you like, type your question into the chat. I'm not sure I'll be able to see that, but feel free to.
Joel, do you want to maybe, while we wait for people to come up with some questions, talk about the audience for these courses
Certainly.
and who you think would be the best fit?
Yeah, let me just scroll back a couple of slides here. So in a broader sense, foundations and commodity trading hedging actually used to be the same class. We realized, based on feedback from students, that it was just too much information for a four-week class. It was overwhelming. We had a large number of students that simply just couldn't manage it within the time. So we split them apart so there'd be a little more breathing room with the material. The types of students that we typically get in foundations and masterclass commodity trading hedging are a pretty wide variety. We'll get people who work for commodity trading companies and are risk managers, fundamental analysts, quantitative analysts, salespeople, originator, who want to understand essentially the trading perspective on the market. Uh, I was a commodity trader. I probably should introduce myself a little bit. My name is Joel Rubano, and I was a commodity trader for 20 years. I've worked at pretty much just every about kind of firm in the industry. And I now am a lecturer at the JPMCC. We as traders were traditionally very bad at communicating what we were doing to the rest of our firm. As a result, sort of we were a bit difficult to understand. So people didn't understand how we were taking information and translating into price. We didn't understand how we were arriving at our decisions. They didn't understand any of that. So the people that show up to foundations are generally relatively early career people. They tend to be either students or people who are interested in the commodity markets or people who are working at a commodity firm and are trading desk adjacent, trying to understand what's going on there. They want to understand how the traders or how the industry as a whole takes information and turns it into a perspective. What do you think about oil? What do you think about natural gas? What do you think about coal or corn or anything else? This is how you do that. So the foundations essentially answers that question. How do you come up with a perspective on where the market is going to go? From there, we had a lot of students that would continue on to commodity trading and hedging. That one is primarily focused on how one actually transacts. For people who are interested in being traders, who are junior traders trying to learn some technique, people who aspire to that role. We still have a lot of people who are not ever destined for a trading role who take that class as well, just because they want to understand that perspective. They want to understand what a commodity trader does. But we tend to see people who are a little more specifically headed for a trading seat or are trying to that show up for commodity trading and hedging. We do also, actually, I should add, get a fair number of people who are interested in new markets. One of the neat things, and one of the things I'm most proud about the all the master class foundations and the master classes, is they are never the same. We have a core set of material that we cover in every class, but one of the things that's great about them, from my perspective, but students seem to like it as well, is that we have live sessions that are held weekly. And the live sessions are essentially where you're able to make the course your own. Um, the course will be different depending on who's taking it at any particular point in time. Everyone has their own interests, and I try to make sure that I find out what those are and try to bend the course as much as possible to suit the needs, interests, and things that you find fascinating at any particular point in time. So if we have a class that's got a lot of people who are interested in agricultural markets, I will try to steer the material in that direction. If we have a lot of metals people, we've had situations where a particular firm has booked huge numbers of seats in one of these classes. So as a result, we try to bend the class a little bit in that direction. But one of the things that's the best about it is that you can bring any type of question. You can email me 2 or 3 days ahead and say, "Hey, I want to look at this. I'm curious about this aspect of the commodity markets," or "We went over this week. I'd like a little more depth on this topic." And I think that's one of that flexibility is one of the best things about the master classes is that it can be a little bit more plastic to service the needs of the people that are in the class right then.
Joel, I'm happy you shared that and kind of a follow-up if you could explain the format because we have, recently changed it where, you will have live discussion periods with participants in the course every week. And I think that is such a selling point for the class that they get the opportunity to pick your brain. And you kind of touched on that saying, hey, you can send me questions ahead of time and we can talk about it. So can you give some more kind of background to the structure of how you set up those live discussions versus the
Absolutely.
recorded video lectures that they receive?
Absolutely. So the bulk of the course material comes from a couple of sources. So there's the textbook Trader Construction Kit. Then there are a set of 8 classes, 2 of which are covered each week. The material for those is recorded ahead of time. And this is done because we traditionally get a very international student body um, from all over the place. And it worked out better. And also, a surprisingly large number of the people that take these master classes and foundations are actually working at the time. So most people aren't necessarily available at a particular point. So we made the decision to sort of make a lot of the material, the bulk of the recorded material be asynchronous. So that way you can watch it whenever fits your schedule. The lectures are broken down into usually something like 10 to 15 minute long videos so that they're readily consumable. And there'll be a set of 4, 5, 6 of them for each of the lessons. So a student can consume that material at their own pace, review it as many times as they like. It's all there to be used. That material will inform the Q&A or the discussion session, which is held weekly. Those are usually about an hour long, but in all honesty, they almost always go longer than that because usually that's the most, as an instructor, that's the most fun that I have. And I love talking about this stuff. So the Q&A sessions are whatever anybody wants to talk about. I will usually try to bring some material in the case no one has any obvious questions. I'll try to bring something that is germane to what's going on in the world right now. For example, if I had one this week, I would definitely be talking about the announcement that came out about the coordinated release of from the global SPRs in the oil market and how quickly that may or may not impact things vis-a-vis crude oil prices. That would be an interesting thing to talk about, particularly if we were talking about directional trading or if we were talking about fundamentals. So that could be applicable to either. So I'll try to bring things that are as current and as fresh as they possibly can be and as real world. Everything in this course is designed to be real world. These are not theoretical courses in the sense of they're not full of equations. Everything I was a practitioner, everything that I do is practitioner related in the sense that I'm trying to essentially prepare people for a career in the industry based on the information that I got in the industry. So it's you're not going to be doing a lot of math, but you will be sort of doing a lot of theoretical work and understanding how things work. And we'll talk about very practical aspects of everything because again, the goal is to have everything be as true to industry as possible.
Thanks, Joel. And as we're coming up on time, I didn't know if anyone had any other specific questions they'd like to ask. I'll also be following up this webinar with a link to the recording as well as Joel's contact information if you have specific questions you would like to ask him, and then enrollment information as well. As you see here, we do have all three of these classes are being offered this spring, and we typically offer these classes twice a year. So if spring doesn't work out, you can always look at our fall dates, and I'm happy to help with any enrollment questions that you may have. But thank you for attending, and we hope to see you in one of the classes in the future.
Thank you.